Are you an established small business owner or aspiring entrepreneur? Would you like professional advice to help your business grow and succeed? Well, look no further. The Virgin Islands Small Business Development Center is the territory's #1 resource to move your business forward. Enjoy no-cost advising, low-cost training, and technical assistance from experts in both the public and private sectors. The VI SBDC is nationally accredited and sustained by the University of the Virgin Islands and the U.S. Small Business Administration. Visit us at our locations on St. Thomas, St. John, or St. Croix, and follow us on social media at VI SBDC. For easy access to all our training and networking events, be sure to join our newsletter and download the VI SBDC app. The Virgin Islands Small Business Development Center, here to help your business start, grow, and succeed.
Good morning, everyone, and welcome to the VI SBDC's hosting of Advanced Financials for Entrepreneurs in the USVI. Participants would learn financial planning, budgeting, control and auditing, creating financial statements, payroll accounting and terminology, and end-of-period reporting procedures for existing businesses as a means to managing small business financials. Sorry about that, as we were experiencing technical difficulties. Allow me to introduce today's lead presenter, VI SBDC State Director, John Morosco. Before returning to the Virgin Islands as the VI SBDC State Director, John had many years working as a certified business advisor in Iowa, Washington State, and the Virgin Islands. In addition to the years with the SBDC, John has been a successful business owner, college professor, and nursing home administrator, and worked in corporate America for more than 35 years. He has spent most of his career working his primary job and teaching at many colleges nationwide. John has extensive experience managing restaurants, hotels, assisted living, and nursing facilities. He has also assisted with his family restaurant and owned a college consulting business and a janitorial business, which he later sold. John holds a Bachelor of Science in Hotel, Restaurant, and Tourism from Florida International University and a Master of Public Administration in Long-Term Care from the University of New Haven. Here's a friendly reminder to put your questions in the chat, and they will be addressed either directly in the chat or later during our question and answer segment. A copy of this presentation will be attached to the post-survey email sent out after this live event. We encourage you to take a few minutes to fill out that survey that lets us know how we are doing. So without further ado, State Director Morosco, the floor is yours.
Thank you. Thanks for that technical. Sharika bailed me out on that one. I left the mic open. So welcome, everybody. And today's presentation, I really encourage everybody, we're looking at advanced financial training, and that can go in so many different directions. We only have an hour and a half. So right up front, the plan that I have is I'm going to do more training starting in January, and really in depth on ratios and some of the other things, because in this hour and a half, my hope and my goal is just to give you the overview as business owners, what to look for, so you can really start to gauge what your business is. Last week, we talked about 3 reports for beginners. And this week, we're going into a little bit more in depth, but looking again at the income statement, the cash flow statement, and the balance sheets. We're going to be looking at a little bit today on planning for profit and how to maintain and improve your revenue control system. So we're going to touch on all of these, and I'm going to give you that wonderful, as I call it, that deep dive on how to interpret some of these. A lot of times I use accountants, bookkeepers to create these reports for me, or put put my numbers into QuickBooks. However, when I get the reports back, the goal I would hope for you as business owners and future entrepreneurs, if you haven't started the business, is that when somebody hands you these reports or you created them, that you're able to interpret what's going on. How is your business doing? When they all come out, there's a reason for having all three of these reports that we're looking at. So business and financial analytics, that is a valuable way for every business to make really better decisions. It can help you to respond early to risks, opportunities, and trends that can affect its operation and success. And these analyses may prevent you from making most common, costly, and completely unnecessary mistakes. And I say that because when I've seen so many times where people are in business, and we at the SBDC, I had somebody not too long ago came in and said, the bank is wanting to come and take my belongings, basically, because they were shutting down. And so the question I always have is, when it's at that point, it's almost too late to save your business. I don't want anybody to ever be in that position. If you're monitoring as you go along, you're really reducing the risk of getting yourself in trouble. It can still happen, but in business, the whole idea is to be making money. So what we're looking for, and this is kind of the guide of what we're doing today, analyzing financial results using the income statement, the balance sheet, and the cash flow. Again, anybody that was in the training last week, we touched on those. Now we're going to start to analyze what you as business owners should look at. So it's really important. You're not going to be experts at the end of this session, but through constant looking at the numbers, working with the numbers, come see, as I said so many times, come in and see the SBDC advisor. We don't charge for our work. So it's a really good way for you to work with the advisor to monitor how your business is doing. Again, we don't have judgment. What we're doing is looking at what you've done. And a lot of clients that I work with, they bring their financials in, and we sit down and we go through the income statement, we go through the balance sheet, and we go through the cash flow to look at how the business is doing. Is it healthy? Is it not? Are there things that are out of line? And this is doing this from the beginning. As soon as you can, and you're running your business, if you're not doing it now, I highly recommend this, because it's going to give you that aha moment in most cases of what's going on within your business. So today I'm going to do the introduction to financial analysis. We're going to talk about the income statement analysis, the sales volume within that. We're going to look at some of the expenses, analyze labor. Labor is one of the first things that can sink a company, is, and I had that personally when I had the restaurant. I'll keep putting people on board. All of a sudden I'm going, holy mackerel, I don't have enough money. I found it. I didn't have enough money to pay the employees. And it's like, boy, that was a bad decision on my part. So live and learn the hard way. We're going to talk about the fundamentals of the balance sheet, the analysis of a cash flow statement. And we're going to go again a deeper dive into it. And I think it's all going to come together for you. And then we're going to look at the income statement versus the balance sheet with cash flow. Just a little bit of discussion about that. And at the end, I'm going to be talking about what lenders are looking for. If you need to get a loan, if you're looking that you want to in the future, find a lender, go to a bank, go to a private lender, whoever it may be, the things that they're looking for. And I got to tell you, these three reports are essential, not only for you to understand your business and to monitor how your business is doing, but it's essential. These are the three reports that most lenders are going to look at. And I'll show you today as we go through what they're looking at. So at least you have a little bit of an idea of that. So, planning for profit, the guidelines for success, doing your financial analysis and profit planning. Why do owners need to analyze the financial reports? And we were just talking about that a little bit. We're also going to talk about cost, volume, and profit analysis. I will touch on budgets. I'm going to do again in January an entire session on how to do the budget, because right now we're going to be looking at assuming the company that's in business. And as you're doing that and you get a handle on that, you really need to be turning around and saying, what does the future look like? What am I budgeting for? What's happening? You know, are things happening? What I call environmental scanning. What's happening out in the world? You know, is there a disruption of oil in the Middle East? What is that going to do to our fuel prices? And depending on your business, do you depend on that? What you can anticipate? And then again, developing a budget, really important to be doing, and then monitoring that budget. So these are all areas, again, you're going to hear some repeats as we go along, but maintaining and improving the revenue control system. And basically, number one is, what is your revenue security? What are you watching? What are the external threats that you may be looking at with the revenue security? Internal threats, you know, somebody within your organization just ripping you off. So developing a revenue security system for yourself and complete the revenue security system. One of the best things, I don't know how many of you have POS systems. That is one of your best lines of defense right there, because it just takes push a button and you can start to see what's happening in your operation. I'm a fan of having those. So when I'm looking, is there a difference between, and we're talking about cost accounting, managerial accounting. Cost accounting, and when we're looking at this, I would assume most of us are not accountants. I bless anybody that's doing that job right now at the South Puget Sound Community College. I'm teaching managerial accounting. And I sit there and I kind of roll my eyes. I'm going, I can't believe I'm teaching accounting, because I leave the experts to check my work. And that's how I'm going to phrase this right now. I put numbers together. I get the bookkeeper or the accountant take a look and say, yes, this is in line. No, it's not, because I know a lot about this, but I want the experts in those areas to look at what's going on. So when we're talking about cost accounting, it's documenting and analyzing the sales and profits is the main thrust behind that. However, that same activity is more appropriately described as managerial accounting to reflect the importance managers and owners should place on the process. So as you're thinking about what you're doing, you can say, okay, I'm doing some of the accounting work, or I'm managing this. But think of yourselves as that it's managerial accounting, because you're putting that effort in to make sure that everything is in place and the processes are working properly. So we talked a little bit about this last time, and I'll stop referring to last week pretty quick here. But bookkeeping is the process of recording and summarizing financial data. It's important that you understand the difference. So we have the information the bookkeeper is taking and recording, summarizing the financial data. What is our revenue? What is our expense? Managerial accounting is the analysis of record and summarizing the data. So the bookkeeper is putting the information in. The managerial accounting person, that part of the accounting, is actually doing an analysis of what has been put in, recorded, and then coming up and summarizing what is going on within that business. So that's the main difference between the two. And the effective managerial accounting decision rely on accurate bookkeeping. So it's a full circle. It does go back. And whether you're doing the bookkeeping or you hired someone to do the bookkeeping, having this information done correctly is very important. Now, when I did my own books, I always sent it to an accountant and said, audit what I've done to make sure that everything is in order. And as we go along today, we're going to talk about, what kind of system do I have? Some people still use a ledger paper, a piece of I have one client that uses a notebook. They write down all of their sales, their revenue, and they write down all of their expenses. And right out of this notebook, they come up with where they are. The issue that's going to come up, and we've been talking about, is at some point when you're paying your taxes, you have to have more information. Otherwise, you may pay too much. And if you're collecting taxes, what are we doing with it? So there are reasons. You have QuickBooks, which is the gold standard. I want to say most people like QuickBooks. It is, if you're a really small operation, there are other accounting softwares out there that are a little bit more user-friendly. QuickBooks is a bear. I teach a QuickBooks class, and it's a 10-week class, and it's a real struggle to get all the students through that 10 weeks and cover everything that they need to know for the basics of QuickBooks. There's another system out there, it's called Quicken. And that one is, in my opinion, a little bit more user-friendly. So when I talk about these different brands, these different companies, please don't think that I am saying one is better than the other. You have to go in, assess it's good for you and what will work best for your organization. So I just want to make sure I'm not pushing one or the other. So now I'm going to start jumping in to the financial analysis as we go along. So part of your job is to sift through the information, and you're going to look at the analysis that's going to shed light on exactly what's happening in your operation. What you're looking for is, and it's sometimes basic, but we forget, how much money did we make? How much money did we spend? And how much profit did we make? You know, I have to say those three are really why, in most cases, we're in business if we have a for-profit business. You know, how much money did I bring in? What did I spend? And how much profit did I make? All three of those will be important to making some decisions on what you want to do. So when I look at this, the financial reports related to the operation of a small business can be of interest to management. They want to know what the financials are looking at. You're the manager, you're the owner. You want to see how the business is doing. You have stockholders, or I say stakeholders, that a lot of times in companies, there are other people out there that have an interest in what the business is doing. You have the owners of the operation, and you also have creditors. They want to know what the financial reports are and how the business is doing. Government agencies, yes, because you have to pay taxes. And again, I'm going to mention, for those that didn't hear about BOI, I'll talk about that in a few minutes. And then in turn, the general public. I put that not quite as much, but the public wants to know how companies are doing. Sometimes if it's a totally private company, they're not going to get a lot of information. So your job, though, is when you're producing, you want to look and produce accurate financial statements that work. And what you're looking for is it creating a sound financial analysis. You know, each system provides information that can be used to analyze the business's financial standing. So there are 4 statements that are used. The top 3 are the income statement, the balance sheet, and if you look next to the balance sheet on here, it's the cash flow statement. And not as much the statement of retained earnings. I just wanted to put that in there, the key concepts of the financial statements. These are also important, and they work together. I said last time, it's like a 3-legged stool. To sit on this and to have its really integrity, you have to have all 3 legs working there. By the way, if anybody, when you get the PowerPoint and you get the PDF, which Sharika will be sending out, I put references down here because a lot of times there are some really there's good information out there that I share, but I'm not taking total credit for it. The experts, I went in and I said, yeah, I agree with what they're saying. So throughout, you'll see these references. So please feel free to download them and take a look yourself. So it's important that you understand that you don't need to be a certified management accountant or a CPA to analyze the everything that's related to revenue and expense. You are the experts. You know what's going on in your business. And if you don't, that's the time to turn around. Let's find a way. You should find a way that you can really see how strong your business is. And again, I don't know how many times I've heard somebody come in the door and in here is when I'm advising and saying, it says, you know, I have money, I made money, but I can't pay my bills. We'll kind of answer that today. I did in the first class. What it comes down to is knowing how all three reports work together to give you that, the ability to do that analysis. So just, I wanted to mention in 2002, the United States passed this, Congress passed the SOX Act, and that law imposes criminal penalties on those found to have committed accounting fraud. I'm not saying anybody has done that. I just want to make sure that you are all aware that that law is out there. The other one I will spend a couple of seconds on right here. We're talking about the Financial Crimes Enforcement, the BOI. Reminder that this report is due. You need to fill it out. All business owners, if you're an LLC, an S Corp, sole proprietorship, no. But you need to go through, do I need to file this with the federal government? Okay. Because every business owner, what they're looking for is fraud. They're looking for people that are laundering money. So I'm not sure how the whole system works, but they're requiring every single business to register. We looked at it yesterday with one of our clients. I've done it and I electronically, but if you do the paper, which I don't recommend, personally from what I've heard from everybody, is that it's about 4 pages and you're putting in information about you and your company. And you are then going to be registered in this Financial Crimes Enforcement group with they call FinCEN. So just be aware, it is coming up January for anybody that's been in business prior to 2024. So if end of 23, if you've been in business, you have till January 1st, December 31st to file this with the federal government. If you started your business in 2024, you're supposed to have done and filled this out within 6 months. Okay, so if you started your business in January, it's already late. I would hope that there is a forgiveness period. And then anybody that starts a business, if you're planning to start a business in 2025, you'll have 30 days to complete this form once you have your license. So it's important. The fines, I understand, are like $1,000 a day, and they're coming after people from what they're telling us. Will they or won't they? I don't know. But you need to be aware of that. You don't want to start getting these fines. And we have a video that you can watch. It's on a YouTube, and you can just go down, and it's really a neat video. It's a class that we did about doing the BOI and filling it all out. So what you're going to be looking at is, in that video, there are 3 different people showing you how to fill it out. And my favorite accountant person is Hector Garcia. And he just looked and he said, it's a hot mess, but we're all required to do it. So there, I've done my community service. We are pushing. If you know anybody that has a business, let everybody know that this is a requirement if they are an LLC or an S Corp. All right. Sharika, I'm just checking any questions at this moment. Okay. So I'm going to start out now. I'm going to do a little bit deeper dive with the income statement. And because I am an expert basically in restaurant and hotel work, some of the financials that I'm going to show you are restaurant related. In the long run, they're almost the same. There is one major difference, and I'll just do a quick point out because of how the restaurants with the uniform system of accounts, how we report and do the income statement. And when we're looking at that, it's called the prime cost in the restaurants because it's so hard to make money and it's a very dangerous business basically to stay in business. What we're looking at is what are our sales, what are our expenses, and then we're looking at payroll and what are our labor costs, and that is the first part of the sheet. That's the only difference between the regular, what I would call regular business and the restaurant. That we're putting labor cost up top to watch that first. So one of the three important financial statements, and I've said it so many times. Sorry if there's noise. We have a school group here. It's a lot of fun seeing everybody running around. So the statement, what they're used for the company financials were during the accounting period. So we have the income statement, and as I said, I will point out again, it's also called the profit and loss statement. If somebody said to you, I want to see your profit and loss, just know it's the income statement. Or the other way around, if you have a profit and loss statement and they say, I want to see an income statement, same report. I have no idea to this day. I did some research to find out how it got two different names. I couldn't find an answer to it, but it does. They're both acceptable. So during the accounting period, the two other key reports that we're going to look at today is the balance sheet and the cash flow statement. So now we get to, before I introduce them when we did the financials for beginners, now we're going to start looking at, and I really encourage you, the most important thing that you can do as a manager is to look at certain areas of these reports because it is going to let you know what's going on. Are you going to be an expert right away? Absolutely not. Okay, but there's certain things that you can look at and say, hey, what is my business doing? What happened? I'll give an example. I had my food cost percentage, I watch it like a hawk. The industry standard is 35%. I was running at 34% in my restaurant, in the family's restaurant. And then all of a sudden, 1 month, it jumped up to 40 some odd percent. It's either I have spoilage, but that was the key. I went from 34 to over 40%. So were we throwing out food? Was there spoilage or was there theft? So those are some of the things that we look at. What is it that, and that was the tip off, something's not normal here. So as I just said, the income statement is also known as the profit and loss statement. They're both the same. So when we're looking at that, it's the precise definition of exactly what is meant in terms of profit. So that must be established for each P&L statement, preparing to help and communicate this information properly. So what we're looking at the end of this report is what was the profit? And you're going to see, I'm going to be talking about percentages in a minute. For each industry, there are different percentages that are industry norms. One purpose of the P&L statement is to identify net income, which is the profit generated after all expenses of the business have been paid. So we have our sales. After we've paid all of our expenses, basically what's left over. And that's going to be our net income. But there are other pieces that will show up in different reports. So an income statement can best be understood by dividing it into 5 sections. The revenue, how much did we take in? Expenses, how much did the operation, what did we spend to do this operation? What gains we had, what losses, and then the net income. And these are usually arranged from most to least controllable. Okay, if I have a loss, I may not be able to, or a gain. Sometimes I have control and sometimes I don't. And that we when we look at reports, is it controllable expense? Is it non-controllable? These are things that we would look at. So the income statement lists revenue first, then expenses, and finally the difference between the revenue and the expense figures. Not to worry, I have a little chart coming up next. So I know it's a lot of words, but just kind of hear it. And then when we get to the chart, it's going to help. I'm going to do a simple statement. If the difference is positive, it represents a profit. I know it's basic, but if the expense exceeds the revenue, a loss we're looking at the loss. And you can show it by a minus sign or putting it in brackets. And operating at a loss, a lot of the industry terms that you hear is we're operating in the red. I had never heard of shedding red ink, so I put it in there anyway. If anybody knows where that came from, drop a note to us here. But shedding red ink, I hadn't heard that one before. But operating in the red, I think anybody in business, we want to stay away from that. All right, this is really one of the most simple income statements that you'll ever see. Okay, it's taking my revenue. Merchandise, what were the merchandise sales? In this case, what was the revenue from training that they did? And then the total revenue of $30,800. Then they took the expenses and they list each one. And you see the total expenses of $10,650. Gains, they sold a van. Okay, income from the sale of a van. That's where the gain came in. Settlement costs from a consumer lawsuit, that's the loss. And then when we look at the very bottom, this is the net income, $21,350. Okay, pretty straightforward. Now, I want to point out a couple of things. One is in this, and I'm just going to use this example, wages is $700. So what is that? How is that broken down? How is that made up? How do I know that we got that $700 in this spot? This is the final report. If you use QuickBooks or some of the others, you can run this. You can run a summary report. This would be a summary, or you can run a detail income statement that is going to show where all these numbers came from. That's what we call a supporting document if you're doing it by hand. So what made up the $700, when we get to wages in the supplemental document, it's going to say what made up that $700. How did we come up with the total? That was the total, and that total got put into our final report. Again, a couple of ways you can run a report. If anybody's using QuickBooks, I really suggest doing a detailed report. Find out what's going on with your business and watch carefully, because if I look at these numbers, this particular income statement it's great for what we're doing today to show you what an income statement can look like, but it's sure not telling me a lot of what I need to know as far as a business owner. And I'm going to go into this. So revenue expense categories on the income statement are most often presented in two ways. One is the whole dollar amount. That's what we were looking at here. And then percentages of total sales. And I'm going to use an example. Again, we're coming up to a restaurant sheet. Forgive me. It's, well, no. It's the top half. This is the top half of the income statement. But it happens to be for a restaurant. So one of my jobs in the past is I was like a troubleshooter for hotels or restaurants that were in trouble. I would go in many times and, when I came into an operation, was it having problems? I was able to go in, pull this particular report, and immediately identify what's going on. Can I do it from what we were looking at before with the whole numbers? This is not really telling me anything. You know what's telling me the story? Are the percentages. Last year, food sales was 82% of their revenue. This year, it's 81%. 1% difference. In the real world, I'm not really worried about that. Unless there's a big number. Remember what I said, you're the investigator. I really encourage you, learn how to read your percentages, because it's going to tell you when something is off, like my food cost that I had, when I said it went from 35%, in this case, they had 37% last year. This year it's 37.3. They're pretty consistent in what they're doing. Even though the revenue has increased, the percentages don't lie. They give you a, if I'm just looking at the revenue, I'm sorry, this was the cost of sales. And if I'm looking at the cost and what it cost me, last year is 712,000, this year is 767. I can go, oh, that, it's increased by, what is that, $50,000. However, what are the percentages telling you? The percentage is telling you, hey, we're consistent. We don't really have a problem. And that's the whole point of what I really want everybody to pick up here is, as you are the business owner, and if you use Quicken or QuickBooks or so many of the other software programs, you can tell it what reports you want to run. And I highly recommend that you run a report that's showing, I like the comparison of what happened last year to this year, but also what is the percentage, and compare the percentages, because that's going to tell me a lot of what's happening within my business. The only one I see that really, if you look at how close these numbers are, okay, the only one that I might question is the beverages at 22.8%. This year, the cost was 20.0. So in a sense, that's better. The cost of beverages last year was 22 cents on every dollar. This year, it's 20 cents on every dollar. So when I'm comparing that, it could have been as simple when I do my investigation that the company that I buy liquor from gave us a huge discount, and we did a volume discount. We ordered 300 cases. So it costs us much less. It costs us half of. So these are the things you can start investigating when you know that. And I talked about prime cost. This is different than most financial statements, but in the restaurant industry, we look at prime costs. We look at the sales, and then cost of sales, the total cost of sales and total cost of labor. And that's going to give us let us look at what the dollars are really doing. Now, if you look, what this is telling us is 67 cents out of every dollar that this restaurant took in is going just to pay the food and to pay the labor cost. That doesn't include anything else like mortgage or anything else. So it's a really tight business. That's why we do prime cost. There you go. You are now experts in prime cost. So again, please look at the percentages. It tells the story. That's how I always look. So, when I went into a company and I went into a particular property and they say, well, we don't know what's wrong. When I look at this, I look like such an expert because I know how to read the percentages. I don't have to try and figure out what the difference is in the revenue because that really doesn't tell me much. This tells the story. And you as owners should, when you're doing your income statement, run the report, even if it's just this year, run the report with the percentages. You can ask again, QuickBooks, Quicken, you can ask them to run, you can just program it to run that way. Now, if you're not comparing last year, my recommendation is if you're doing this year, do this year for the month and this year month to date. Where are things in line with where you expect it, or are they out of line? So this will give you the first clue of what's going on with your business. So here is the rest of the income statement. And so again, percentages tell me the story. If I do a quick analysis, we have direct operating expenses. Okay, in the restaurant industry, that's everything like to-go containers and everything else like that goes into there. But if I look at the percentages real quick as I run down here, this establishment is really that there's occupancy costs. Well, they probably raised the that went down because revenue went up. This is a fixed cost, the 120,000. If your revenue goes up, that means that your percentage, the cost percentage is going to come down. It's opposite thinking. But other than that, when I go through everything and look at it, this organization, if I were to assess, and if I came into your organization, let's say, even if you're in retail or if you're running a lumber business, a construction business, this is going to tell us on the income statement what's happening. And just pointing out why restaurants, how many times have you seen restaurants go out of business? This is the industry average is between 5 and 7% profit in the food service industry. That means for every dollar that they took in this case, 4.5 cents of every dollar is all they made in profit. It's all based on volume. So a restaurant can get in deep trouble if they're not watching inventories and everything else. But that's a whole nother lecture. So you've now looked at what is as you're analyzing this for your business, think about it. Going in, if you're starting a business, setting this up the first time. If you're in business, start looking at how you're reporting, what you're looking at, because it can be a real aha moment. Now, net income, you saw in the restaurant here, it was 4.4%. If you are in, let's say, the retail business, or if you're in construction, or whatever your company is, you can go to Google and say, what is the industry standard for my type of business? It's like, if I looked at a timber company or a lumber company, and the industry standard for that industry overall, okay, is running at, they say, 35% profit, okay? And your profit is running at 15%. You should be asking yourself, what the industry standard is 30%. And this is from statistics from all over the country. I'm running 15%. Now, there could be very good reasons. We're on an island. We have to ship everything here. I don't know, the other day, I almost choked. I paid $12.95 for a pound of butter. And I was at one of the stores that was a little bit more expensive, but it just broke my heart. But why? Because we're on an island. If anything refrigerated has to be shipped in. There's a cost involved there. So that can be adjusted. And you're looking and say, okay, the 15% is good here on the island, but the industry standard is 30. But then you can start investigating and saying, yeah, I could tighten up on this, or I could change this. This is where the analysis comes in that is so critical for business owners. And I do encourage you, again, with us at the SBDC, we do not charge for anything when we're working with clients. And you can bring your financials in, and we'll actually sit down and we can analyze it. If you're not familiar with it, by the time we get done and you feel really confident, you will be the expert. And that's happened so many times, and it's great to watch that the business owner all of a sudden have this amazing independence. So salary, so when we look at sales category, including the revenue generated by all sales and purchases, so the sales category, again, is the revenue from all of our sales and purchases made by customers and staff. And then it's less the expenses. So that is the basics there. Now, I'm going to go back here for a second. I want to point out direct operating costs, because I talk about supplemental reporting. How did we get here? Notice this 132, 143. Just kind of keep that in the back of your mind, because I'm going to go here. And if I look at direct operating expenses, this is a sample of a supporting schedule. How did I come up? And if you look here, the expense, 132, 143, look familiar? That's how we got the number to put into the income statement. That's what your accountant's doing, and that's what you need to be doing, because oops, sorry about that. You need to break down all of your in what makes up the direct operating expense. And you have the GAAP, which is the generally accepted accounting process principles. That's a standard. It has your chart of accounts. Everybody, it's like, okay, I have uniforms. I'm cleaning uniforms. Do I put it under cleaning? Do I put it under uniforms? laundry and linen. I love, and then when something happens that's out of line, I love this one. Again, it's a restaurant, china and glassware. I can't tell you this happens a lot. The expense is higher than budgeted because the china shelf collapsed on March 22nd. So we're explaining why this number, these are notes that are important, not only to you, it's so you can remember, but let's say if you have a board of directors that you have to answer to, or an owner, or a lender that said, why is this expense this high this month? What happened? So you have that explanation. But the long part of this is you break down all of these direct operating expenses. Here's the schedule. And again, I'm just going to jump back here, that 132. And that number is then, that's how we put it into and how it's generated either by the computer, by QuickBooks, or manually. But that balances out to what the total is. Now, if I remember I was saying run a detail report, it will have 132, and then all of these other numbers that we had just looked at. Okay, all of these will be below it. So on a detail, all of this will show up. So if you really want to see what's going on, you can do just the regular report, the income statement. But if you really want to dig down onto what made up those numbers, like here, the 132, 143, I now have a better answer. So as you're looking at this, as you're looking at your operation, decide which way you want to take a look at that. Okay, so the P&L statement is only one of the several documents which we keep talking about. The P&L statement alone, however, yields important information that is critical for developing the future management plans. So you really want to keep after this. You want to know, I was saying there are three reports. This one is the one most business owners are familiar with, and managers. This is the one that's used so many times. It's showing you what that net income came out to be. But I'm going to show you in a couple of minutes why the other reports are just as important. So the income statement is an aggregate statement or a summary of the income and expenses. I'm just giving a little bit more detail about that, about the income statement. And the detailed income and expense information can be found in supporting schedules, which I just showed you on that. So when we're looking at this, it's determining sales for a particular accounting period. I can choose a month, a year, whatever it may be. I choose what I'm going to run. Okay, usually everybody will run a report at least monthly. If a business is in trouble, I've seen people run it daily to see what's happening, what's going on. And then you're going to calculate this month's sales less the period. Let's see. Okay, I'm sorry. When I'm looking at the sales volume, calculate this period's sales minus last period's sales. And the difference, if I step 2, is that I'm going to be able to figure out a variance report. I'm going to figure out what the difference is. Now, a lot of times the computers will do it for us. That sounds a little complicated, but what I'm looking at is if I want to find out what's happened, in this case, I use the 205 this year's minus last year's, and that I came up with a total. I take the new total divided into last year's sales, and that means I had an 8.9% variance. In other words, this information, even though it says it was 82% and 81%, what we changed, the shift in sales, it was up by 8.9%. I'm just pointing that out. You don't, if you want to know more about it, stop in. I'll work with you on these numbers. For time's sake, I just want to keep us on the move here. So, and the same thing with what we're the increase when I'm looking at a variance. You should start looking at a variance. Today, we're going to look at it just for a couple of minutes, but what is the difference and what is it telling you about your operation? So, and then you're, again, following this formula, we'll have it for you. But if we're looking at, and again, forgive me, a lot of these are food related, but if you look at this, I want to know what's going on. I had This is a detail. This is again, that supplemental, that's that detail report on the food expenses, what we had for meat and seafood. So these are the percentages based on the sales. So I know that for every dollar I took in, 15.7 cents of every dollar went to pay the cost of that particular item. So when we get down to the bottom line, it's 37.7, 37.3. And if you remember, that matches what we had back on that just general business statement. But here's what I want to show you. Just kind of look at these numbers. I don't want you to memorize them. But what I'm looking for as a business, as a manager, is I want to see what's happened, what is the variation in these expenses. And you can do this with clothing, you can do it with lumber, you can do it with just about anything. But the variance is on the food for the meats and seafood went up by 1%. It was an increase in an expense between last year and this year. Okay, then we're looking at fruits and vegetables was a variance of 1.2%. Dairy dropped. So what it does is it gives me a quick look at what is actually going on. Is there an area that the variance is out of control? For me, and again, I'll relay it to a restaurant. I had an item that was called seafood fra diavolo, and it's lobster, clams, mussels. It was really good. And that one we would sell for, an example, I don't remember the exact prices, but let's say we sold it for $25, but it cost me $20 to make. That margin, I'm making $5 on each item. Okay, versus the, let's say the chicken Parmesan, it cost me $5 to make and I charge 20. I'm making $15. My margin is increased. So these are all things that you can start looking at. What's the variance? What's my margin? And it's really important that you keep track of that and see how it's working for your organization. A lot of detail here. Please, please, please ask questions. Stop in, see us, because I'm giving you an overview. We still have to go through the balance sheet and a few others. I am going to touch on keeping track of labor costs. Okay, that is one of your biggest areas, expenses. And it's really important that any operation that watch what's going on with labor, keep that under control. And I say that from personal experience. I almost sank the business by not monitoring how much. Oh yeah, have them come in, no problem. And then the realization that I almost put the business out of business was such a wake-up call for me. And I had just finished college, so yeah, I thought I knew everything. Well, guess what? I didn't. So that was that wake-up call for me. And why I say for your organization, you've got to control what you're spending on payroll, especially if you're in retail or anything like that. In the service business, you just got to watch it, because there are other expenses that, not only are you paying the payroll as an owner, anybody that has employees know that you have the debt burden for paying and matching funds in certain areas for having the employee. So I'm going to kind of skip through this a little bit, but the effective manager, you'll seek to achieve reductions in operational expense because of the improved operational efficiencies, not because of reduced sales or unintended restrictions in sales or service. So what we're looking at as an effective manager is control my expenses whenever possible. I cannot control the rent because I have a lease, and the lease is, I know that that's going to be the same. What's controllable? Do I turn out the lights? Do I make sure everything is turned off at night so I don't have a crazy electric bill? Is, with the gas usage, how much am I using the gas for the vehicles? What is, so all of these things that come into, there are a couple of ways to control what's going on. If you want to make more money, you can increase your sales, you can decrease your expenses, or you can do a combination of both. Okay, that's one way that you can control and make more money. But sometimes it's, if you can't, I just look at some of the prices that I see at hotels are a perfect example. Right now, it's like $300 and some odd for a hotel room here on the island. So at what point can you not raise the rates anymore? I think we're at that point. Personally, this is a personal observation, nothing more. I'm not necessarily an expert at the Virgin Islands hotels, but being in the business for almost 40 years, I look at what they're charging and what the resistance that comes up. So if I can't charge more for an average hotel room, what are my other options? Well, it's controlling expense. How are we going to be more efficient? Are there ways to do it? And sometimes there's not, and it's going to eat into your profits. I had a commercial cleaning company, and this is back in I sold it in 2007, just in time for the recession. All my investment went right out the window. But the key was, I was in business, did really well, but I had made a conscious decision for myself and my operation. I started the employees for cleaning businesses and cleaning houses. I started them back then at $20 an hour. Why? Because I wanted the very, very best, and that's what I felt was a living wage for people back in that area. So what happened was, what's the result? My bottom line, I did not make as much money as I could have. And I was okay with that because I understood my financials. I knew I was covering all the costs, but I never had any turnover. I should say I did have turnover, but very, very little. So these are things that we are looking at. So when the total sales dollar volume increases, fixed labor cost percentage will decline. And I'm going to, you can go through these. I have some really fun ways, the formulas on how to look at what's going on. When I'm looking at the labor analysis, I'm just taking total sales and what we spend in labor, dividing that into our total sales, and that will give me the percentage of what's going on. And again, I just use for a management, and I'm looking at what's happened between now. Remember, the sales had changed, and it went up like $60,000, $70,000, $80,000 with total labor costs between last year and this year. But the percentage, again, that told me the story. They're in line. And the reason it went up is there was more business and they had better revenues. So these are the keys. As you run your management and you run your business, one thing I do recommend, if anybody here is having trouble controlling their payroll, I do suggest that you really keep a daily. I can supply you and just contact me. I'll give you a simple form that you can fill out on a daily basis. What I paid, what the labor cost me, and what my revenue was. And by the 15th of the month, you're going to have a good idea how and what your business is doing and how they're doing it. So I'm going to skip this. Now I'm going to jump into, as I'm looking at the that's the income statement. Sharika, any questions so far? No. We are fortunate here. We have kind of a shift in our office. And so my esteemed colleague is just sitting down at the end of the room. So we can wave at each other. It works well. So the balance sheet, okay? This one, I will say people get confused with the balance sheet. I personally hate putting together a balance sheet. I let my accountant do it most of the time, but you have to be able to read it. I have to be able to read what's going on. it can get a little complicated, but everybody here that's participating in this call, I am sure that everybody here can put one of these together. So what is it doing? It's showing there's a formula, and we're going to talk about this, to make what it's looking at is assets, liabilities, and shareholder equity, what I call owner's equity, at a specific time. Anytime you have a balance sheet, it's a snapshot of when you run the report of that day. And it's not going to show you past, it's going to show you the snapshot of today. So just kind of keep that in mind. Then we have the balance sheet is the financial statement that reports the company's assets, liabilities, and shareholder equity. And I call it owner's equity. Again, this is the second of the 3 reports we're talking about today. We talked about it's a snapshot. And there's a formula that is followed with this, that we have assets equal liabilities and owner's equity. And I put it down here. Shareholders' equity, owner's equity. This is the formula. So, I was not a fan of algebra, but this is pretty simple to follow. I'm going to give you a quick example I use this with my clients all the time because they look and they say, the balance sheet, what is this and how does it work? I don't understand. And it's okay because there's certain things that I'm going to show you that you can look for. But the formula on this report is assets have to equal liability and owner's equity. So I use the example with my clients of if I bought a house and the house is at the $400,000, the house, $400,000, that's the asset. That's on the left side of the equation. Then on the other side of the equation, the equal sign is liability and owner's equity. So if I still have I have a $400,000 house, if I have a $100,000 mortgage left on that house, okay, that means the owner's equity, the owner has 300,000 they own 300,000 of that house. So 300,000 owner's equity plus the mortgage of 100,000, that's 400,000. The house is worth 400,000. Guess what? You're in balance. There you go. That's a simple analysis of the balance sheet. It's much more complicated. And that's why I always love when I use Quicken or QuickBooks to do this, or I have my accountant put it together. But I'm going to show you a few tricks with that. This is when you get this, I would just look through it. It gives you more of a detail of the assets, what they are, liabilities. It includes the amount owned on loans, accounts payable, taxes. It gives you more of the detail, but the sheet I'm going to show you next will kind of break it down. What's important to remember under owner's equity does not necessarily represent current market value, therefore should not be replaced the comprehensive valuation. So that is a whole nother section that we will go through, but they're saying, just kind of be careful. This is just a general, and it's a pretty good overview of what's going on. So here is a sample of a balance sheet. I'm going to first do, oops, am I missing? No. Okay. So the first thing I do whenever I'm working with a client, because banks are going to want to see this. If you're going for a loan, if you're going to a lender, they're going to want to see this. Why? Because it's going to tell them how much debt you have and are you going to be able to pay your bills. That's a simple way for me to say this. So in this case, but the first thing I do is I jump down to the bottom of the report. Total assets, $770,000. Okay. And the total liability and stockholder equity is $777,000. Guess what? It's in balance. Assets equal liability and owner's equity or stockholders' equity. So what makes this up? When I'm looking at the balance sheet, some of the things that I really would encourage you to look at, because this gives you, yes, cash and cash equivalents, short-term investments, when I look at this, my eyes glaze over and I say, okay, Mr. or Ms. Accountant, fill this in for me, please. I can do it, but I choose not to. How's that for honesty? But there are certain areas that you as a business owner really need to be looking at. One is accounts receivable. That's the net. So this is money people owe you. So the question I have is 39,000 percentages would help a little bit, but there's $39,000, almost $40,000 that people haven't paid me yet. Are you on top of it? Have you been running the accounts receivable reports? Who owes me money and how am I going to collect it? The rule of thumb is that if you ever looked at accounts receivable report, it's usually 30, 60, 90, and 120 days, and then past that. My rule of thumb in business has always been if something hits 60 days, in other words, the client has not paid me in 60 days, I pull out all the stops. I call them, I send letters, I do not let it go because my experience has been if something slips into 90 or 120 days, your chances of collecting that drops way down. So you take a chance of losing money. So I want to see how much in my accounts receivable. In this particular case, I don't know if that's good or bad because I don't know this company. But I still see it, as a pretty hefty number. On the balance sheet, the other thing I look at is if I'm tracking inventory, and a lot of companies don't, but if you are one company that does keep track of the inventory, and I do like it when people set up the systems to track inventory, but it takes a lot of time and effort to get it up right. So inventory, but everybody, I just want to point out to all of you, that's an asset. Yeah, I have $31,000 worth of merchandise or whatever sitting on my shelf, collecting dust. That's a lot of money to be having sit on the shelf. Can you tighten up your ordering so we get it closer? And we do this a lot of within businesses, just in time ordering. So I know that it takes me 3 weeks to get a particular item. I order it 4 weeks out when I see that I have to replace it. Because my goal is, and for you, is you always want to have the merchandise you need. But the question is going to be how much do I have sitting on the shelf? And can I tighten that up? So this is money that's not making you money. You spent money to pay for all this. It's just sitting there. Investments, and then land and building. This is really an equipment. This is really where I turn it over to the accountant personally. Again, I can do it, but when I'm looking at accumulated depreciation, I let that person with that higher degree than I have in accounting do that for me. And then intangible assets. These are really interesting. 105,000 they have for goodwill. So these are things, the total assets, again, they calculate it out to 770,000. And again, just real quickly, what is the current portion? Oh, I didn't point out too. Current assets, current liabilities are anything that's usually due or comes in that will be handled in 12 months. Long-term, anything like notes payable, in this case, the bond payable is a long-term debt. But as I'm going through, this is the other one that I want to point out that you as business owners should be looking at. What's your accounts payable? If you have set up credit with certain people, certain businesses that you get your supplies from, keep track of what your accounts payable is so you don't all of a sudden say, wow, I can't pay this. This is, again, an accumulation of all the money that you owe. Okay, so this is, to me, the most important. I pointed out, I think, some of the most important parts of the balance sheet to look at. When I take this and we have clients, we take it to a lender, they're able to see real quickly what is the lender. These guys are expert. They'll look at this and they'll say, well, this is not right. This is too high. This is too low. And it's like, yeah, thanks for letting me know. So but I know, number one, it's in balance, and there's key for me, I'm looking at the things like supplies, things that I can control. What's going on, and is this reasonable? Remember, it's a snapshot. This is as of today. Tomorrow, when we do all, you have sales and you have expenses, this snapshot will change in correlation to what you have done in your sales. So now, this is the most telling of all the reports. I'm going to be doing this, the cash flow statement. This is where, and I said earlier, people go, oh, I can't pay my bills. Well, this is the reason, because I'm going to show you on a cash flow sheet that we use with the clients when we're doing the projections of cash flow, why that happens. Okay, so as they say, the financial statement is, when we're looking at the cash flow, it aggregates a company's cash flow, the cash in, the cash out from the operation, investing, finance over a set period of time. Okay, so the bottom line, when cash flow statement has three sections: operations, investment, and financing. So everybody kind of stick with me. We don't want you to feel overwhelmed by this. I'll have a couple of examples in a second. So, and this one with cash flow, even if you use the accrual method of accounting, what you're going to be looking at, the cash flow statement is a focus on cash accounting, allowing the managers and analysts and investors to assess how well the company is doing. I got to tell you, when we send a client to the lender with a finished business plan, the one thing that the one area that the most lenders go to, in our experience, is the first thing. They have the entire business plan there, it's well written, but most lenders and people that are going to lend money will go and look first at the cash flow. Does it make sense? There's one line I'm going to show you in a minute. Does this make sense? Then they're going to go to the balance sheet and do their little magic, which I was just talking about. They're more expert at it than I am, but I know enough to make sure that the balance sheet is, number one, in balance, and that the numbers are looking accurate. And then the last one is the income statement. So they're looking at all three of these to make a decision. Is this person worth, is this information that I have, are the financials worthy of moving on to this next step of reading the rest of the business plan? That's just the reality. And it's not 100% of the time, but I would say at least 90% of the time, that's what's going on there. So why should you watch cash flow and statements along with the other financial statements? It's a useful way to tell how your company is doing financially. And I'm going to jump in. This one, I'm just going to show you. You're going to get a copy. And I'm just looking at the time. We have about 20 more minutes, I think. So when I'm looking at this, this is what's happening with the cash flow, but I'm going to try and make it a little easier for you. Again, operating section makes up the cash flow, investment section, and the finance section. When you're using QuickBooks or you're using Quicken or some of the other financial systems, this all is generated just from all the information that you have, sales with your expenses, everything that you've put in. This report is generated very quickly. So you can just do this with pushing a button, but it's important that you be able to see what's going on. I'm bringing up something real quick, and I just do this. This is a template. Can you all see this? I hope. This is a template that we use, that I use with the clients at the SBDC. And it's really neat because when you go to a lender, when you go to the bank, who's ever lending you money, they want to see what we were just talking about. They want to see the cash flow sheet. They want to see the balance sheet. Oops, and that one is hidden. Where is it? There it is. Balance sheet. And they want to see the income statement. This particular worksheet, it's in Excel there that we put together the few of us, and I just let you know, we calculated that there are over 600 formulas in this sheet to make it work. So it's like when I give it to a client, I say, make a master copy, because it's not if you corrupt a formula, it's when you corrupt the formula. But I'm gonna show something that I think is important. This also does, if I wanted a $100,000 loan, I don't know if you all realize that most lenders are gonna want 20 or more % down. So I want 100,000. That means I have to, as the owner, contribute 20,000. The bank is then going to make up the difference. Basically, they took your 20,000. So there's your $100,000 loan. 10 years, 2%, 2% closing fee. And I don't know what we are at interest rates right now. I'm just going to change this to 8, because I know they were so high. Starting in January of 2025, right away it calculates out what my monthly payment is going to be. This sheet also does an amortization schedule. But what I wanted to point out is, here's the key why we say, oh, we didn't make money. If I come over here, I just put in just one area. This is the 100,000 that I put in. I would have to, I'm going to say, let me just do this too. I'll leave it for now. Remember that loan that we just did? The interest on that loan, this is the way accounting works. The interest is an income statement item. Okay, the principal is a balance sheet item. In other words, if I'm just looking at the income statement and I had paid this, the income statement is not showing that I had to pay $443. That's going to the balance sheet. This is the key that's so important, why we do all of these reports. I'm hoping that makes sense. Because when we report, okay, they go to different areas, like all these expenses. This one is going to the income statement. Certain loan and information, the proceeds are coming to the balance sheet. So as we put this together, as we start working, it's nice. Forgive me, right now it's showing that there's a loss every month because I only put in one thing. But as a lender, this is the line this cash flow line is what the lender is looking for. And you as business owners should be doing the same thing. If I'm doing business this way over 12 months, what's happening to my cash in the bank? Okay, in this case, they started with $100,000 and you see each month it's dropping. So again, this is only one area. This is the first place that you need to be looking at. What is my ending cash balance month by month? So important that you do that. I'm just going to go in and put, just to have fun here, revenue of, let's say, $150. That's my average. I'm a tire store. I'm selling tires. So let's say I sold 20 tires a month. Again, these are not necessarily realistic. I hope I'm selling more than 20 tires a month, but it generates what my revenue is. So the revenue, expenses, and then you see, look at my cash flow, it increased nicely. And then equipment. I got a $100,000 loan, but I spent $80,000 of that buying equipment. So I need to change, that number will change. Look how this affects, I only have 20,000 left in my slush fund, basically from the loan. And so I'm constantly watching. Profit and loss is important, but what's key is what is the money in the bank? This is where most businesses get in trouble, and happy to work with anybody. In this particular sheet, we are going from the actual numbers. When we're working with clients creating a business plan, this is going into the future. It's looking into the crystal ball saying, this is what we project is going to happen. This, Mr. or Ms. Banker, is what we anticipate for our financials. And they will ask tough questions. What happens with, did you account for this? Did you account for that? This is why anytime that you're working with the numbers, I encourage you to do them so you have an understanding. In the long run, you can have someone do it for you, but how do you read it? What is it? look like. And when I put in those numbers, just so, let's see, okay, I have my balance sheet. Yay, okay, remember we just put in, we had the cash, 20,000, that's from the loan. And then we had no short-term no current liabilities at this moment. But remember that loan that I put in, here's accounting for that. Again, it's on the balance sheet. So if you look for 2025, I have, I'm estimating 124,000, and I rounded up, and here 124,082. It's in balance, and you notice that there's no difference. It's in balance. Assets equal liability and owner's equity. So that report that we were just talking about that you saw in the balance sheet, when we do this with our clients, when we're creating the business plan, again, lenders want to see all three of those reports. You're going to be able to, in this one, we have it programmed that it does each one. In this particular case, here's the income statement. Okay, and according to this, and I haven't fixed that error yet. I didn't do that right. Okay, and I have another error here. This should be a percentage. Where's my percentage? I don't see it right off the bat. So anyway, what we're looking at is, this is 82%. I'm just laughing. I know it's here somewhere. It's just hidden right now. I have to correct that. So what it's saying here is that because I don't have real numbers in here, I just showed some revenue and I showed some expense. They're saying 82 cents on every dollar is profit based on the projections that I did here. So as you're going through, you know, it's like, okay, I have to pay insurance, liability insurance for my company. It's $500 a month. So these are all, this is where we start really filling in the numbers, and you as business owners, I encourage you to do this because, you know, even though this is forecasted, what am I paying a month? How does it look? If I do this, if I bring in, you know, the revenue, let's say if I change the tire price to $200. So look at the revenue here is 36,000. If I change it to the average, and again, we have all these other categories that are not filled out here. Oops, 2,000. So I went from 30, so my revenue, projected revenue, jumped up to 48,000. That's a nice way to, you can start looking at your business. What happens if I increase this number? What happens if I do this? So you have two things going on, which I love. You have your actual numbers. Everybody that's in business, you have actual numbers, and today is the 21st. At the close of business today, that's, as I call it, that's the wall. Everything that you've done up to the 21st, that's where the financials end. What we're looking at here is I'm forecasting what's going on in the future. I can look at trends from the past and predict where we're going in the future. So as I start to wrap this up, because I think I'd like to see if there are questions, and we're getting pretty close here. Just the key element in this whole thing, we just had lights flashing. I hope that we don't lose internet. So when you look at the income statement, again, think back to how many times people say, I made money showing on the income statement, but I can't pay my bills. The reason is right here, because not everything that you're doing in business goes to the income statement. So we have income statement, that's revenue, and the balance sheet items, again, income statement, and then other balance sheet item. Anybody that has an LLC, we usually don't take a paycheck, but let's say you would most likely take an owner's draw. Now, I will point out, there are different ways to do this. You can actually take an owner's draw, but you can have your accountant file that you are an LLC, but you are paying federal taxes, so you don't get caught with that at the end of the year. So there are different ways to do this. But in most cases, the LLC, you know, and this person is making $5,000 a month. Hopefully you are all making money, but again, look what it did to my balance sheet when I put in, now I don't have revenue all the way across, But when I paid myself $5,000 a month, look what happened to my balance, to my cash flow. I'm in the red. I can't pay myself that kind of money and still make money. And that's what we're in business to do, is to make money. Okay. I think that's what I wanted to point out. Let's see. Good afternoon. Oh, are you talking about this workbook that I just showed here? You can unmute if you want. I don't know. Everyone. So I will say, if anybody would like this formula, would like my workbook, I don't charge for it. I will give that to anybody that would like it. So just send us a note and we'll make sure that you get that for yourself. Okay? Any other questions? Okay. Ms. Sharika, are we good? Oh. Okay. Oh, you're welcome, everybody. So will we have access to the people that put in the chat that they'd like the workbook? Okay. We'll take a look at the chat and make sure that you get that. I really hope that this is, again, everything was just supposed to give you an idea of where you can take this. Now, don't be afraid to reach out to us to assist you. Again, everything we do is confidential at the SBDC, and we don't charge for what we're doing. Our purpose is to do what we're doing here, is to assist businesses to grow. Okay. I thank everybody for being here. I'm going to turn it, Sharika, I'm going to turn it over to you. And let's see. Thank you, everybody. Okay, sorry.
Okay, so I see requests in the chat so that you guys can receive a copy of the workbook. So please make sure that I can identify you. I see a few business names up as well as devices. Send me your first and last name in the chat so I can make sure that you're on that list that would receive the post survey email, and we'll attach the workbook and a copy of today's presentation. Okay, thanks. So once again, the VI SBDC has so much more in store for USVI small businesses. You can visit our website at www.visbdc.org. Download the VI SBDC app on your mobile device from the appropriate app store. Like and follow us on Facebook, Instagram, Twitter, Google Business, and you can subscribe to the VI SBDC YouTube channel for new uploads of our on-demand webinars. I just wanted to be able to give you guys a preview of the trainings that we have coming up. Thank you, everyone who has placed their name in the chat. We have coming up SBA resources every small business should know. That's going to be on December 3rd. And on December 10th, we're going to have Surety Bonding 101, and that will be with the SBA again. So you can see our contact information up there. You can scan our QR codes. Make sure you download our app. It's complimentary. If you're interested in making an appointment, you can go to our website and select the advising page, or you can follow the steps through the app to make sure you sign up so you can receive an appointment. John, you can hear me, but you're not on mute. You're actually on mute. So we have persons in the chat indicating, thank you so much for this presentation. It has been helpful. They've learned a lot. And I see persons still putting in their actual name and their email addresses so I can get this information to them.
And if I could,
Exactly.
I'm going to jump in. If I can say to all of you, great that you were here. It's a wonderful step forward for your business to be successful. Don't be afraid to reach out and just have fun with this. And numbers sometimes are not fun and we're busy, but go for it. Enjoy it. I cannot get back to you.
Okay, so persons are free to leave, but if you're getting your name in the chat, we are receiving those emails, so you can get a copy of this. I just want to give a friendly reminder, after the live event, we convert this to an on-demand webinar format, so you can go back to the VI SBDC training portal and you can watch at your leisure. It's going to be available until the end of this year. Okay, so as we give more persons the opportunity to put their emails in the chat, here's a friendly reminder to fill out the survey that lets us know how we're doing. This is how we are able to report our efforts to make sure that these types of webinars can be offered complimentary to you. I'm going to share a comment here. Thank you, Mr. Morosco. This was great. As business people, we start our business due to our passion. However, the financials is the foundation of the business and it's not fun, but thanks for the breakdown. Okay, so I don't see any more emails in the chat, any more comments. So on behalf of the entire VI SBDC network, thank you everyone in attendance for taking time out of your day to be here with us. And we look forward to having you in more events in the future. You can stop by and get registered and sign up so that you can take part in our services. Bye, everyone.